Hello and welcome to my Literacy to Legacy Mentors Reframing Your Financial Future Financial Freedom Education Series. Today's series is launching with a discussion about the bear and bull market, the technical descriptions of each, what the market conditions are when each of those happen, and what investors should be aware of as they go into each of these markets. First things first, thank you for being here. My name is Deborah Pratt Burns, and I am a brand and business strategist, in addition to being the Chief Prosperity Officer, founder, and education mentor in the financial services space, particularly behavioral personal finance. So I hope you enjoyed this segment. The bear market began in November of 2023 when stock prices were really plummeting after a very, very tough run. And basically, they fell about 20% at a minimum, which is the technical description. But most accounts, people's portfolios, frankly, saw them go down by 35, 40, 45, some 50% down, similar to what we saw in 2008, when in fact portfolios went down by 60 to 80%, depending on what you had in your portfolio. And you were diversified, hopefully. Anyway, they happen every 5 years or so. The good news is they only last about 289 days or just under 10 months. And the conditions are as such that it's a slowing economy and there's a rising unemployment rate. So when you see those two conditions, you sort of know the bears are coming back, if you will. And obviously the opposite conditions of when the bulls are coming back. So as of probably late 2022, early 23, we began to see an uptick in the stock market, particularly in NASDAQ versus Dow Jones, which is heavily tech-centric. That is where a lot of the AI, artificial intelligence stocks, chip stocks, as well as cybersecurity stocks began to go on a tear, as did EV manufacturers and battery makers. So people who are watching the markets and who are either invested as traders, which are either day traders or trading on less than a 1-year market, meaning they are not holding the stock for more than 1 year. An investor holds it for the long term. You've heard the term buy and hold. So that's what the two differences are between the two. Some people, like myself, are both. So I saw the trend. We did the research. And in fact, we're able to follow that run and profit accordingly, which is the good news. As of June, the market became, technically speaking, a bull market. And that means that the markets were 20% higher than they were in the late 2022 segment. So what happens is that when it becomes a bull market, obviously the economy is robust. There are very strong CPI numbers also related to people's spending, consumer spending. Even though we are having a rising interest rate environment, the unemployment rate has been very, very low. In fact, historically so. And that is always a very good indicator of a strong market and a strong economy. So right now we are in an emerging bull market. And what I suggest to most of my clients and to those colleagues of mine who are in the market, tread lightly. This could be a bubble. We don't really know that for sure as far as AI and the EV market, as well as cybersecurity. Those are the hot buttons, as are, of course, the very major tech names, which you know what they are, that have been dominating the market for years, like the Metas and the Apple of the world. Apple just hit an all-time high today, matter of fact, the 29th of June. But there's no guarantee, past performance is no guarantee of future results. So tread lightly is my recommendation and do your research. Use all of the not only technical charts, graphs, and indicators, but follow the analysts, chief certified financial analysts. There's an organization called Tip Ranks that you can use as a free resource, and they rate stocks as analysts across the world. And it's a tremendous insight into different sectors, of which there are 11, and industries and stocks in particular, and their forecast of how they're going to be doing. So some of you, or maybe all of you, may have noticed that right around the pause in interest rates, which, by the way, has not happened in 10 sessions, it's just been consistently going up, and it's been quite difficult for most people to really keep track of all of their increasing credit card bills, et cetera, but also the incredibly increasing costs of things. So basically, when the pause happened, a number of people, including myself and my husband, have actually taken profits, because we saw this sort of on the wall, if you will. It was all pointing to people were going to take profits because they really didn't know what the Fed, which is the Federal Open Market Committee, was going to do. Well, they did pause, which you'd think would be good news. But as you may have heard the phrases hawkish and dovish, our Fed chair, Jerome Powell, has indicated in a bit of a hawkish, which means aggressive kind of serious tone, and not a soft landing by any means, is indicated that we will have 2 more interest rate hikes this year. And there are several more FOMC meetings this year, and there is a schedule if you wanted to look it up on the exact dates when this is happening. And they could be 25 basis points, which is a quarter point. Now, given that the interest rates have been rising now 10 consecutive sessions, the interest rates are quite prohibitive at this point. So I think people who are investing are seeing that, everything is pretty overpriced and inflated. And it might be a good idea for some of you to sort of take your profits, sit on the sidelines for a minute or two, and then maybe get back in when you see you could get some type of investment, whether any kind of different stocks, whether it's what I've mentioned or others, that maybe are not as overvalued. They're coming down to earth, and they're much more reasonably valued. The other thing you should really take into consideration is the PE ratio. Price earnings, typically a price earnings of under 30 is recommended, because it means that the company is not overvalued. It is a more reasonably valued company, and is one that has room to run, so to speak. So it's important that you look at all of these factors. Bull markets tend to last a lot longer, like 954 days. So we're all excited about that. Those bulls of us, which I am one, bulls among us. And that's the good news. So it means you can have a longer runway to not only invest for the longer term and make money by virtue of capital gains, but also industry is stronger, and the economy is stronger, and things are beginning to look more rosy and more positive than they have in a couple of years. So, of course, we're all waiting for those days, because it's been a bit of a tough run here. These bear markets are never easy. They're actually quite difficult, and it really requires an enormous amount of grit and gravitas to get through them. I do highly recommend that when you do invest in any one of these sectors of the 11, or the market, any one of these market types, that you do so very prudently, and that you take into consideration all of the factors, both macroeconomically and microeconomically, in your own life. And that will lead me to another show I'm going to be segment I'm going to be showcasing on the importance of really doing a look back, a 6-month look back, of which I just completed, which I'm absolutely delighted I did, and just thrilled to have such enormous clarity, because then we know collectively exactly how much capital we have to invest in the market and how it's going to meet our short and long-term goals. So I wish you tremendous luck and success. I hope you use your resources wisely and invest wisely. There are other resources out there. Obviously, the Wall Street Journal, I hope you're reading that, and Barron's, excellent resources for investors and traders. Our favorite actually happens to be Seeking Alpha. That is a professional trade journal and trading platform of research. That is, it's not a platform; it's a resource, and it really is extremely comprehensive. And you can be in various degrees of membership, depending on your acumen in the market and your expertise and your interest. So that is the latest on the bull and bear market. I wish you a tremendously profitable and fun ride. And thank you so very much for joining. And I hope to see you again sometime. And I do hope also that you subscribe to my channel, because I'm doing an investing series for the summer. And since many people have downtime in the summer, it'd be a tremendous time to watch and to learn. Thank you so very much for your time today. And if you're interested, I am a mentor, and I have several different types of packages I offer to my clients. And one of which is very popular right now, actually, is a 3-month In It to Win It program, which I'm all about. And it basically teaches the fundamentals of abundance mindset, abundance planning, as well as the fundamentals of becoming an informed and confident investor. So if you're so inclined, go to my website, literacylegacymentors.net. You can actually click on the mentoring packages. You will see a brilliant testimonial there from one of my dear clients. And there are many others under the testimonials tab on my website. And we'd love to have you join for a In It to Win It program. I also happen to have a 30-minute Financial Freedom Accelerator program, whereby if you have issues that you really need immediate feedback on, and you have to make pretty serious decisions in a very short period of time, you can retain me for half an hour, and I can more than likely give you a direction in which to go that is better than the direction you were going. So I look forward to hearing from you. I look forward to having you join me, and all the best, and have a tremendous summer in the meantime. Thanks, and happy 4th.